I'm so glad to see so many of you here in person. On behalf of CAAR, I'd like to call this meeting to order and welcome you to our annual Development and Economic Summit. To begin today's meeting, please stand and join me in reciting the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. You may be seated. Now we will be moving on to the approval of the minutes from the May 12th meeting. The minutes were included in your handouts you received when you signed into the GMM. They were also included in the handout link that you received in your reminder email. And they're also available in the chat box for those of you who are on Zoom. Are there any additions or corrections to the distributed minutes? If so, please raise your hand or submit your feedback using the chat box in your Zoom toolbar. Anybody from Zoom? If not, then they stand approved as distributed. Thank you. At this time, I would like us to acknowledge CAAR's antitrust statement. This statement ensures that we are encouraging discussions that promote all realtors and does not restrict competition among members or potential members. We work to foster a forum for open discussion of diverse opinions without attempting in any way to discourage or sanction any business practices. The CAAR antitrust statement will be acknowledged before every CAAR meeting. For a full copy of our antitrust statement, please reference today's handouts. We are extremely grateful to the following sponsors who have helped us provide this great program. Our supporting sponsors, VA Home Picks and Southern Development Homes. We value the professionalism, service, and support of our affiliates to CAAR and its members. If you haven't already visited the sponsor tables, please do so during the reception and before you leave today. September is Realtor Safety Month. Together, we should talk about safety, create a safety plan and follow it, and encourage all of our fellow realtors to do the same. The National Association of Realtors has a robust safety webpage to ensure every realtor comes home safely to his or her family every night. Please visit nar.realtor/safety today and review the various resources available to you. We also strongly encourage you to register for the 2 safety classes being held this month at the Hillsdale Conference Center. Our safety classes will be taught by our own CAAR Board of Director member, Ben Reeves, who has an extensive law enforcement background. Please make safety a priority. Lockbox service is a big component of how we operate our business. Shown now is a map of Virginia Realtor Associations and what lockbox provider they currently have. CAAR is evaluating the 2 lockbox services available. Supra, which is CAAR's current lockbox service provider through August 2023, and CentriLock. Please complete the CAAR 2022 lockbox evaluation survey by noon on Monday, September 12th. And it only takes 5 minutes to complete, so it's easy. So everybody please go and do that. While your name is not mandatory, you can include it for a chance to win a $50 Wawa gift card 2 winners will be selected. As you know, we all can use a gas card. A QR code is on the screen for you to take the survey now, and a link is currently being shared in the Zoom chat window. After you have taken the survey, please register and participate in the Supra and SentryLock demos meeting on Monday, September 12th from 1 to 3 p.m. at the Hillsdale Conference Center. And in-person and Zoom options are available. A representative from each service provider will provide a demonstration, lockbox demonstration, a presentation, and they'll take questions from the audience. Please participate in this important decision. While we have seen the real estate market cooling over the last few weeks, it is essential that we keep a close eye on interest rates, consumer confidence, inventory, and the effects of COVID-19, which is still out there. We are thrilled to provide you an exclusive market forecast focusing on consumer and builder data with 2 national speakers. Brandi Snowden, Director of Member and Consumer Survey Research with the National Association of Realtors, and Danushka Nanayakkara-Skillington, Assistant Vice President for Forecasting and Analysis with the National Association of Home Builders. Following a presentation from both Brandi and Danushka, as well as a short reception, we will invite Ryan Price, Virginia REALTORS Chief Economist, to moderate a panel discussion. The panel discussion will allow the audience to ask questions. Those in person, please use the index card you received as part of your handouts to write down your questions in advance. You may then drop them off at the front of the podium during the reception. Zoom participants, please use the Q&A window of your Zoom toolbar to submit your questions. If you would like to know more about the panelists, please refer to today's handouts. At this time, I would like to invite Brandi to the podium.
Thank you for inviting me here today to share some of our economic updates from our Chief Economist, Lawrence Yoon, and also how some of this data compares to some of our survey research data from our members and also consumers. And from our monthly Realtors Confidence Index survey, we gather timely information from our realtors based on their real estate transactions from that month. And we saw that in July, properties typically remained on the market for a median of 14 days. And this is the same that we saw in June, and also down from 17 days 1 year prior. And we also see that 14 days is the fewest days on market that we have seen since we've been tracking it since 2011. Then also looking at the share of homes that were selling in under a month, we saw that 82% of our respondents reported seeing that their properties sold in less than 1 month, which is down from 88% just 1 month prior, and also down from 89% 1 year ago. Then also looking at the average number of offers that we see our members are receiving on their most recent sale. We see that homes typically receive 2.8 offers on average, and this is down from 3.4 offers in June of 2022, and also down from 4.5 1 year prior. And then the high that we see on this trend line of 5.5 was reported back in April earlier this year. And then looking at our existing home sales release, our existing home sales data, which is released on a monthly basis, we see that in this past month, existing home sales showed a decrease of 5.9% from June. And year over year, we also saw that sales were down 20% from 1 year prior. And then also looking at our total housing inventory, we see that housing inventory currently sits at 3.3 months. And then for 2022, right now, Lawrence is projecting home sales to be lower than in 2021, which would be a return to pre-pandemic activity. And then right now his forecast for 2022 is 5.31 million. Then also looking at the median home prices, which we report in our existing home sales for all housing types in July was $403,800, which was up 10.8% from July of 2021. And we see that home prices continue to increase in all regions around the country. And also looking at Lawrence's forecast, right now we see that Lawrence is forecasting home sales to be down at the end of 2022, but also continues to see rising home prices and projects that home prices will be up 8%. And then also looking at some of our survey data. So we also produce our profile of home buyers and sellers report. And from this report, we also look at some different spinoff reports, including our generational trends report, but looking overall at the profile of home buyers and sellers. We also ask about the number of weeks that a home was on the market before it was sold. And we actually see that among our recent home sellers that homes are typically on the market for just 1 week, which was a drop from 3 from the year prior. And then we also ask about the final sales price for these homes that were sold. And we saw that among, for recently sold homes, the final sales price was a median of 100% of the final listing price, which we saw across all regions again. And similarly, we saw that among our home buyers also that they typically were purchasing their home for 100% of the seller's asking price. And then looking from our members' perspective in the our annual member profile report, we can see what factors they think are limiting potential clients from purchasing a home. And we see that the top reason that they see is the lack of inventory at 57%. And we saw that that even surpassed housing affordability in this last year, but we see that that is still another big concern that they're seeing, and also difficulty in finding the right property for their potential clients. And then looking into some of the characteristics of our recent home buyers and recent home sellers, and looking at the generational differences between these buyers and sellers and our generational trends report, we saw that this year the combined share of our older and younger millennials rose to 43%, making millennials the largest share of recent home buyers, followed by our Gen X buyers at 22%, and then also our younger boomers at 17%. And then among all of our buyers, we saw that the share of first-time home buyers increased to 34% from 31% the year prior. And we see that this is the largest jump that we've reported since 2017. And we also see that our younger millennials made up the largest share of first-time home buyers at 81%, and they are followed by our older millennials at 48%. And then looking at the typical median age of our home buyers, looking at first time and also our repeat buyers, which is the green line, we see that the typical first time home buyer was 33 years old this past year. And we see that that has continued to hold steady from last year. And we see that the typical repeat age, the typical age of repeat buyers rose to 56 this year. And that is the all-time high that we have reported. And then also looking at household composition among all of our buyers, we see that 60% reported that they were a married couple. And we also see that 19% were single females, 9% were single males, and also 9% were unmarried couples. And among both our older millennials and Gen X buyers, we saw the highest share of our married couples that were recent home buyers at 64%. And interestingly, we see that our highest share of unmarried couples was among our younger millennials at 21%. And then looking at the household income of our recent home buyers, we see that those between the ages of 42 and 56, which is our Generation X buyers, that they reported having the highest median household income at $125,000. And we also see that they typically bought the most expensive homes and also the second largest homes. So we see that since they're also most likely to be married couples or unmarried couples, that they might most likely have a dual income that can support these larger houses and more expensive houses. And then looking at the location that our recent buyers chose to purchase in across all generations, we see that the largest that buyers were typically purchasing in a suburb or subdivision area, followed by small towns. And we see that also looking across all generations, that buyers are typically purchasing single family homes more than any other type of home. And also we still see that our younger buyers are choosing to move to the suburbs, small towns, which might be more affordable areas for them. And also looking at the distance between our recent buyers' previous residents, we see that younger generations were typically moving a shorter distance when relocating. And among all of our buyers, we see that they were typically moving 15 miles, median 15 miles. And we also see that that distance was lowest among our younger millennials, but we see that among our older boomers that they were typically moving the furthest distance. And then also looking at the primary reason for purchasing a home, we see that overall among all of our buyers that they were really looking and had the desire to purchase a home of their own. And especially among our buyers that were under the age of 57, we saw the largest shares of that desire to own a home of their own. And then among our buyers that were 57 and older, we saw the desire to be closer to friends, family, and relatives as the top reason, as well as looking for potentially a smaller home. And then looking at some of the website features that our recent buyers found as that were very valuable to them and very useful to them during their home search process. We saw that photos, property information, floor plans were cited as very useful most often. And especially during the pandemic, we saw that our three virtual options at the bottom became much more important. And we saw that all of these three website features increasing in importance from our previous year's report. So looking at virtual tours, virtual open houses, and also virtual listing appointments. And then as we continue to see our inventory shortages, we continue to see also that finding the right property remains at the top of the most difficult steps of the home buying process for our recent home buyers. And as well, we see that among our younger generation, our youngest too, that saving for a down payment continues to be difficult, as well as understanding the home buying process and all of the paperwork that's involved in that. And this past year, we saw that the typical home buying search lasted for a median of 8 weeks, which is the same that we saw as last year. And we saw that buyers typically viewed a median of 8 homes also. And see that our youngest and our oldest generations were viewing slightly less homes than that median of 8. And also we see that among all buyers, they typically viewed 3 of those homes only online, and with buyers between 57 and 75 viewing typically about half of their homes only online. And then looking at our profile of home staging report, where we ask our members about the market expectations of their clients. And when asked if their clients' expectations on the number of homes that they expected to see during their home search, we saw that 36% of all respondents stated that their buyers' expectation of the number of homes that they would see actually matched the market. And we saw that 26% said that their buyers' expected number was too high based on the current market. And then we saw that only 4% reported that that number was much too low based on the current market. And then looking back at our profile of home buyers and sellers, we see that among all buyers, that 87% chose to purchase their home through an agent or a broker. And we see that especially among our younger millennials, they were the most likely generation to purchase through an agent or broker, followed by our older millennials and Gen X. So we see that those younger buyers are looking to their agent for advice and help to get through the home buying process. And then also looking at when buyers wanted most from their agent, we see that they're looking for help to find the right home to purchase, help with negotiating the terms of sale, and also help with those price negotiations too. And we see that. So they're looking for, especially those top three from their real estate agent. And then also looking at some of the expenses that might have delayed our recent buyers from saving up for their down payment. We saw that among all of our buyers, 13% reported that saving for their down payment was actually the most difficult step in the home buying process. And among that 13%, we see that some of the expenses that they reported that were some of the debt that had delayed them from saving includes student loans, high rents and current mortgage payments, also credit card debt and car loans. And we see that debt continues to be a significant barrier for many when attempting to buy a home. And we saw that both Gen X and also younger boomers typically delayed purchasing a home for 5 years due to that debt. And that was the largest among any other age group. And then looking further into student loans, we see that among all of our buyers, 23% reported having student loans. And we see that our younger millennials had the highest share of student loan debt that they reported. So 45% reported having student loan debt, and they typically had a median amount of $28,000. And we see that the largest amount of student loan debt was among our younger boomers at $42,000. And then also looking at the typical down payments among our recent home buyers, we see that for first-time home buyers, the typical down payment was 7%. And among our repeat buyers, that was higher at 17%. And we see that especially among our first-time buyers, the share has historically been lower than what we might typically expect a down payment amount to be. So whether that's the 20%, we see that especially among our first-time buyers, it has been below 10% since we've been tracking this. And then looking at some of the sources for their down payments, we see that among all buyers and generations, that savings was the most common source for their down payment. And we see that we've seen another trend over recent years where our recent buyers are receiving either gifts or loans from a relative or friend. And we see that, especially looking at our younger millennials, that 29% received a gift or loan from a friend for their down payment. And also among our older millennials, 21% reported receiving this help. And also looking at the prior living arrangement of our recent buyers, we saw that 24% of our younger millennials lived with a family member or a friend, and that's either with or without paying rent to them. Then looking again at our home staging report, we also ask about the role that family members have played with their clients. So we see that median of 20% of our respondents reported that their buyers are bringing family members with them who are not purchasing the home to also view the homes with them. And we saw that only 8% of our respondents reported that none of their buyers were bringing family members with them. And then we also ask about how they're consulting with family members during the home buying process. And again, we saw that a median of 30% of respondents said that their buyers are consulting with family members during the home buying process, even though they might not live in the home. And again, we saw a small percentage of our members that were seeing no one consulting with family members during the home buying process. And these are just a couple of the many reports that NAR is releasing on a yearly and monthly basis. So if you are interested in any of the reports that I've mentioned, they can all be found on the research and statistics page at nar.realtor. And you can also follow us on social media where we're posting about all of these reports and some of the other data releases that we have. Thank you.
Thank you, Brandi. And I would now like to invite Danushka to the podium. Good afternoon. Thank you. Thank you. I know it's an econ presentation. That does not mean you get to sleep through this, okay? All right. It's so great to be here. Thanks, Abby, for inviting me back again. So today I'm going to talk a little bit about the macroeconomy, see what's going on. You know, it's in the news. The Fed is in the news, right? Are we in a recession? Are we not in a recession? Talk a little bit about the consumer side. Brandi touched on a lot of those stuff too right now. And then speak about the supply side, what the builders are facing, the issues, and then bring everything back with their forecast. All right, so GDP, right? This is what the overall economy is doing. The first two quarters were declines, the first quarter and the second quarter, slight declines. So in a textbook definition, that is a recession, right? You agree, Brian, right? Textbook, yes. But the National Bureau of Economic Research, like the ones who officially cause a recession in this country, it's unlikely to call one, simply because the labor market is really strong right now. But you can see that coming off of 2021, the economy expanded 5.7%, the best year since 1984. So we are in a much slower pace at 1.4%. And then next year, even slower at, just barely growth, right? And then a weak recovery in 2023. The economy is going to slow down. We have just one more quarter, like we are expecting the fourth quarter of this year to be a negative GDP growth as well, but very small recovery in the next couple of years. So we are calling it like a growth recession, where the GDP is growing slightly and the unemployment rate is going to tick up. So speaking of the labor market, so this is one of the bright spots of the economy. So as of July, we have recovered all 22 million jobs that we lost in March and April of 2020. So we lost 22 million jobs in 2 months, and it has taken us over 2 years to gain these jobs back. The unemployment rate is at 3.7%. It ticked up a little bit compared to July, but that's good news because almost 800,000 people started looking for work. Yay, right? Yay. That's what we want. We want people coming back to the labor force, right? We don't want people in the gig economy just doing Uber driving and DoorDash. We want them in the labor force looking for jobs. So that's good news. So, but we do expect, you can see the unemployment rate in our forecast going up to a little above 5%.
So that means that the economy is slowing down, labor market is going to kind of get loose a little bit. You might not see all the help wanted signs everywhere. And then, I don't think it's going to go back up to much higher than the 5% unemployment rate. So this is what we're expecting for the labor markets. Inflation, are you thinking about inflation, the gas prices? Yeah, even my mother talks about it. She doesn't even know what I do for a living. So kind of funny to me. So, she always complains about inflation is really high. I'm like, yeah, I know. So right now it looks like it has peaked, but we are hoping, right? Wishful thinking here. 8.5%. The food prices, the gas price, gas prices have been going down, which is good, right? We are noticing that. But the rent component of the CPI, which makes up 40% of the index, is staying stubbornly high. That's because, if you think about it, you sign a lease once a year, right? So that's going to be a drag for the rest of the year. So that is staying a little bit high, but everything else is coming down a little bit. The car prices are coming down a little bit. Airline fares, coming down a little bit. In the summer, it was up 46%. Now the prices have gone down a little bit. So it's good. Looks like it's coming down. So what we care about is the CPI, the Consumer Price Index. What the Federal Reserve cares about is the core personal consumption expenditure measures. So when the recession happened in 2020, they were okay with this measure going above 2%. So they were like, they flooded the market with liquidity, with various loan programs and everything. And it went way above that. So now they're trying to bring it back down. So it brings us to monetary policy. So monetary policy is a very, very important driver, not just for the economy here, but for the global economy as well and financial markets. So we did revise this yesterday. I did the forecast for September. Considering the remarks that we saw last week from the chairman and the Federal Reserve, they were in Jackson Hole in this important meeting, very, very hawkish stance. So we are expecting actually 75 basis points increase in this month's meeting. And in November, 50 basis point increase. So at the end of the year, we are going to see the federal rate hike, the range between 3.5 to 3.75. And I think he kind of killed the notion that, the rate cuts are going to start happening next year. So we are expecting this higher rate to stay for 2023, and in 2024, for the rate start cutting the rates back to the normal long-term ranges. So why is this important, right? Because higher federal rate has a cooling effect on the economy, because this detects the rates that you pay for your credit cards, for your car loans, for the student loans. This is what matters. For mortgages, it's the 10-year treasury rates. And you notice that the mortgage rates went up a little bit last week too. The June 5.8%, so I think right now it's hovering close to 6% again. The 10-year treasury actually has gone up a little bit too because of the news last week. So we are expecting little under 6% for the next couple of years. This is where we think the rates will be. If you bought a house in the 90s, you'll be like, what is everyone complaining about, right? You paid double-digit interest rates. But man, those house prices, right? It's a real drag. Just this alone compared to last year. Typical home buyer is paying what, $500, $600 more now just because of the interest rates. So this is why it's important. So, we are not going to see 10%. I think around 6% is what we are expecting the mortgage rates to be. But those 2.5%, 3%, I think that's gone. I think I'm willing to bet on that one. So I hope that gave you kind of idea what the macroeconomy looks like. Let's look at what the consumer confidence is doing. Man, we are feeling super moody, right? Right? Look at this chart right here. 2020 happened, everyone was depressed, right? at your home. And then it kind of looked like, oh, the vaccines came, looks like it's reopening, we're all feeling good. And then the war in Ukraine happened, gas prices have gone up. This shows here. This is why it's important. Why is this important? Because consumer spending makes up 70% of the US economy. If we are feeling like I need to hold on to my savings, you're not going to go and buy furniture, or you're not going to go and like do some remodeling, or you're not going to go and like, let me go get this new fancy car, right? You're going to hold on to your savings. And it's important. And also if someone's unemployed for less than 6 months, we haven't seen fundamental changes in their spending patterns. But if somebody's unemployed for longer, their fundamental spending patterns changes, and it takes a longer time for it to go back to trend. So that's why we kind of keep track on this consumer confidence, just to gauge what the consumers are feeling about the economy. Brandi touched on this one. This is consumer debt, right? So it's student loans, auto loans, and credit cards. Credit cards has been declining during the pandemic, and it has risen a little bit, but it's pretty stable when we look at the data since early 2000. Auto loans, it's those 6 to 7 year car loans that are driving up the auto loan debt here. Please do not get those. Yeah, I used to work at JD Power, and one of my jobs was setting the depreciation rates. So let me tell you, after those 7 years, your car is not going to be worth that. So this is inside knowledge. Student loans up 160 points. So for younger households, we saw in Brandi's presentation, these type of loans really crowd out home purchases, right? It's really hard if you're a younger household carrying this debt. And these two type of loans, if you default on them, you're not going to qualify for a mortgage. And even if you declare bankruptcy, student loans never go away. Never. Even if you die, someone has to pay for it. No, only when you die, this just goes away. You have to pay. Did you see in the chart that Brandi showed that these older generations carrying student debt? Did you see that? Yeah, I'm telling you, you cannot get rid of them. So in theory, if you have a college degree, that means it's higher lifetime earnings, right? But the concern is the dropout rate. 1 in 3 drop out of college before they complete their degrees. So 30% of these students have the student loans, but they won't have the lifetime earnings to pay them off. So that's a big concern. So home ownership rates, right now it's at 65.4%. In 2004 was the peak at 69.2%. We don't think that the home ownership rates are going to go up to the 69 levels that we saw in early 2000. The 64 to 65% is a new equilibrium that we expect. Why is this important, right? Home ownership matters. For a lot of Americans, this is their primary source of wealth. And also, if you're a homeowner, let's face it, you're going to spend more money, right? Tying this back to the overall economy, we need people to consumer spending, 70% of the economy. So if you have a home, you're going to spend more money on that as opposed to a rental. At NHB, we measure the housing affordability by the NHB Housing Opportunity Index. It's at 43 right now. This is the lowest levels that we've seen since the Great Recession. This means only 43% of new and existing homes are affordable to someone making the median income of $90,000. Just 43%, that's it. This is a really big concern. So 7 out of 10 households lack the income to qualify for a house right now. So we need to figure out, how do we bring these people in order to be able to bring them up, right? We don't want house prices to crash, right? Even the mortgage rates, something. I know that I read that Bank of America just launched a new program just to help with this, 0% down, data targeting specific people and communities in to help them with this new type of mortgages. So maybe it's something like that. And I've been hearing maybe 40-year mortgages, but I don't know if Freddie and Fannie might back those. But we need to figure out, how do we how do we make homes more affordable, right? So during 2020 and 2021, we saw a lot of domestic migration happening. Everybody kind of fled the Bay Area and flew to the coast, the mountain ranges, right? The mountains, you see the dark green, those are the where you saw the highest population migration happening, like Idaho. What was going on in Boise, Idaho? I don't know. I didn't get the memo on that one. 2.9% population growth happening in Idaho. Florida, and you see the Colorado, Phoenix, all of these areas saw large population migration happening. And what did that do to the house prices in those areas? So these are the the dark blue, the top markets saw house price growth between almost 29% to 36%, the house price growth. So you can see it's the same area that you saw the population migration happening that drove up home prices. So it's the imbalance of supply and demand, right? We didn't have enough houses, but the demand was there. So the house prices shot up. Last slide I want to show you on the demand side. We talk a lot about imbalance of supply and demand. What does that mean? Is that the supply, right? The housing inventory is at all-time lows right now. So you see the existing is the blue areas and the red areas are the new home sales. In early 2000, new home sales made up around 15% of market share. And right now it's around 30%. So we need more inventory in order to support the demand that we see. All right, so we covered the macroeconomy, demand side. Let's go to the supply side. So this is the labor market, the construction job openings. So this includes residential and non-residential. So this is June, but July numbers just came out too. 375,000 open jobs in construction right now. 375,000. Do you know anyone looking for a job? Point them in this direction, right? So at NHB, along with the Home Building Institute, we've done some research to figure out what are the needs for the construction industry for the next couple of years. So just to keep up with the industry growth and the retirements, we need 61,000 people joining every month. That means around 2.2 million new hires for the next couple of years, just to support the construction trades. Why do we have this, right? Why is there a lack of skilled labor? It's because the Great Recession was just absolutely devastating to the housing industry. Many just left the labor force for good. We have an aging labor force. Young people are not interested in joining the construction trades. They are not interested in joining construction as a whole. Women make up 14% of construction trade when women make up half the entire labor force. There was a really cool house that got built in Utah. It's called the house that she built. Every aspect of that house was done by women. Even the marketing, the publicity, everything was done by women and women-owned businesses. These are really, really great. Like, it's NHB is promoting this because just to show that, just the industry is not a barrier to entry for women. And immigrants make up a quarter of construction trade. So we need to figure out like a sensible kind of a bipartisan immigration policy just to bring in people to fill these gaps. Kind of help, like, Japan is notoriously closed country. Even they are, aging country right now. They need workers. So they are bringing in temporary workers at 2 years at a time to fill these. So construction is not just the only industry that we need workers, like manufacturing and service sector. We need people working basically, right? So if we don't have enough workers, that means the supply and demand imbalance pushing up wages for construction trades. Lumber prices. Anybody heard builders complaining about lumber prices? Man, 2021 was like a roller coaster. It's like crazy. Like last summer, the peak was hitting around 1,500 per 1,000 board feet. Usually the average before the pandemic was like 350 to 500. And the lumber impact was adding $30,000 to a single family home and $10,000 per apartment. That means around $90 extra a tenant was going to pay to rent that unit. Just the lumber impact, this does not take into account anything. Right now, the lumber prices have fallen by around at least, like little over 600, which is good. Right now, the lumber impact is $14,000 per single family home and $5,000 around per apartment. That means around $50 extra per tenant. So this is real issues we need to figure out. Lumber tariffs to increasing domestic sawmill products. So, or maybe start thinking of other countries, just not Canada, to bring in more lumber to the country. Steel prices are up 22% in a year. Aluminum prices up 34% since January 2020. Copper prices are now almost 20% above the pre-pandemic levels. Gypsum prices, this is drywall, up 23% in the last 12 months. And ready-mix concrete prices are up 14% in the last 12 months. Everything is up in double digits at this point. Lot shortage. We do this survey every year to ask the builders, what's the lot availability? Do you have a low lot supply? What's going on, right? So that's shown by the red bars here. Before the Great Recession, it made sense that look at the activity, the housing starts, right? The blue shaded area, lots of houses being built. Right now, the builders are still saying that there's a low lot supply happening. So right now, 76% of the builders are saying that. It's the highest since we started collecting data since the 90s. 76%. That means that we need to figure out how do we bring more land to the system, lower impact fees, better zoning rules, or even, like to figure out how do we zone like some of the unused spaces to zone it to residential, right? We need to figure out how do we do this. This is a big issue for the builders. Last couple of slides I want to show you is the regulatory cost. So these are the regulatory costs for a single family home. We do this study every 5 years. Right now, it makes up a quarter of a home price is because of regulatory costs. Comes up to around $94,000. And during development, it's around $41,000. And during construction, a little over $52,000. This is just the regulatory costs for single family. And this is for a multifamily development. 41% of the multifamily development is regulatory costs. We need to bring these costs down. It's crazy. Okay, so all those issues we talked about, the demand side, the macroeconomy, let's bring all these back together to see what the construction outlook looks like. Not very good. This is the flagship index at NHB. This is the NHB Wells Fargo Housing Market Index. This is the builder confidence. It gauges the builder sentiment for the single family market. So above 50 means that the builders are feeling that the market is good, market is optimistic. Below 50 means that the conditions are not great. So right now, if we ignore 2020 was a crazy year, right? Like when that happened, everybody thought we were all going to crash and die, right? If you ignore that part, the builder confidence is at 49 right now. It's the lowest we've seen in a long time. The builders are saying that the traffic numbers, the buyer traffic numbers are at 32. It's the lowest level since 2014. And 19% of the builders are saying that they have to give price cuts now, like around 5% price cuts, just to limit the cancellations. So they're not feeling very, very good about the single family market right now. It's the higher interest rates, the mortgage rates are driving these cancellations. They're saying that if you sign the contract in January and right now, the interest rates have changed dramatically. So they're pulling back. So they need to do price cuts and more incentives to keep these cancellations limited. So we use that to build our forecast here. So 2021 and 2020, incredible years for single family markets, right? 13% growth for starts for both years. Right now, 2022, we have downwardly revised this every month at this point. 13% declines and 980,000 units for this year. This is the first year since 2011 we are expecting an annual decline for single family starts. And then next year, a 4% decline again. And then 2024, we expect the market to rebound to over 1 million units. This is keeping in theme with the overall macroeconomy. And I should mention here, we are building over 1 million in the last couple of years. And in 2024, this doesn't even make a dent in the housing shortage we have, right? If you look at just before the Great Recession, like the 80% fall, we were building around 1.3 million. So just to keep up with the population growth, we needed to be building around 1.5 million. We are nowhere close at this point. So the housing deficit continues. These are the 10 largest single family markets by permits. Houston, Dallas, Phoenix, Atlanta, Austin, Charlotte, Orlando, Nashville, Tampa, and Jacksonville. It's all in the South. This must be the weather, right? It's no surprise because half of home building is in the South. Very big markets, lots of population. That's what's driving the single family market in these areas. So unlike single family, multifamily is really strong. Multifamily market is driven by the low vacancy rates and man, those high rents, right? Double-digit growth in rents. That's keeping the multifamily market really strong. In 2021, 21% growth over 2020. And in 2022, for the first time, we are expecting over 500,000 multifamily units to be started this year. So 17% growth rate. And next year, 6% decline, but still solid numbers with over 500,000 for the next couple of years. So the multifamily market continues to remain strong. These are the 10 largest multifamily markets by permits. No surprise, right? New York is the largest market. Dallas, Austin, Houston, Seattle, LA, Minneapolis, Phoenix, DC area, and Atlanta. The third pillar of housing is residential remodeling. So when the pandemic happened, everybody was stuck in their home and they all decided they need to remodel something, right? Okay, hands up. Did you do something? Yes, see? You painted or something, right? You needed a home office, somewhere for the kids to learn something. So we see this in the data. So in 2021, the market was up 13%. And in this year, we expect 7% increase, and the next year also 6% increase. This is also driven by the baby boomers who are opting to stay and age in place as opposed to sell their house and downsize. So we get a lot of remodelers saying they're getting lots of age in place. You're nodding your head. Yes, exactly. And then everybody wants a home office now. With the hybrid work schedules, before the pandemic happened, around 5% of the labor force could work from home. Now it's up to around 30%. So people need some dedicated workspace. So remodeling market remains strong. So the last slide I want to show you is what this housing outlook looks like for the next 10, 15 years. That is by the population profile. The greatest generation, silent generation, baby boomers, Gen Xers are the majority of new construction buyers right now. And all important millennials. I know you hate hearing about them, but they are the largest living generation right now. That comes with it. They are the largest group of home buyers, like Brandi showed. I know the oldest millennial is at 41. They're called the geriatric millennials. Did you hear? Yeah. I know, it's crazy. So even though they were, everyone was complaining that they were eating their avocado toast and not interested in buying a home, guess what? They're all getting married. And now what they want a home, right? So they're coming, they're coming for you. So they need a home, but we don't have enough houses, right? So right now, the demand looks great. It looks great. But unfortunately, the Gen Zs and the Alpha generation are much smaller population cohorts. So that means when they come into the peak home buying years, that means the demand for housing is going to be much at a smaller scale than what we have seen with the millennials. That's something to think about. I hope I gave you an idea what the economy looks like, what on the construction side, what it looks. So I think we're going to take questions later after a break. So thank you so much.
Good afternoon. How was that TNT popcorn? That was good stuff. Thank you guys for having us up for a panel. I'm Ryan with Virginia REALTORS. We have our two esteemed panelists with us, Danushka and Brandi. I'm gonna take a seat though. Is this working? There we go. So we know that the market here in your region and really all over Virginia, the market is in transition, right? We're seeing it in the data. I know that you guys are feeling it probably with your clients, right? Sales activity, it slowed down from the crazy pace, that we had over the past couple of years here in the CAAR region. And, actually all little trivia for you guys, all 6 jurisdictions that are in the CAAR footprint, all 6 actually had fewer home sales in August than they did in the previous year. All 6, it's all over the footprint. And this is the first time that this has actually happened since, anybody want to guess? The beginning of the pandemic. Yeah. And before that, it was the housing crash. So we're in a transition period. The market's cooling. We're seeing fewer contracts going on, which is actually helping to build up the inventory a little bit. On the new home side, we're having a slowdown in new construction sales in recent months. And so there's a lot happening, right? And a lot of factors are kind of driving this cool down that you guys are experiencing here in the CAAR area and all over Virginia, really. Interest rates, as we talked about, going up. We talked about inflation just really hitting household budgets very hard. And purchasing power, importantly, purchasing power is way, way down, right? So a lot going on, a lot to unpack. But luckily we have our 2 panelists with us today. And we're going to jump into it. We have a lot to talk about. But I think as we start off, it really makes sense to, because we're in this transition period, reflect on what changes have been happening, right, over the past couple months. And then importantly, how those changes are really going to influence the market looking forward, right? Because we want to kind of get ahead of what's happening so we understand and we can advise clients and understand the market as it's evolving, right? So to kick off the discussion, I'm going to ask our panelists now, thinking about the economy and the housing market, the changes that you have been seeing, we've been seeing, really in the near term, over the past couple months. How have those changes impacted the market? What one stands out the most to you out of all the changes? And then the second part of that question is, for our audience, where do you see the market heading in the near term? So we're talking fall, the fall market, or the end of 2022. Anybody want to kick us off?
I can start.
All right.
I'm talking about it from the builder perspective, right? So earlier this year, when we were at the International Builder Show, we presented a completely different market outlook for this year than we are seeing right now. The HMI, the housing market index, has been going down for the last 8 months. So it's at at the below 50 level benchmark at this point. So the market is definitely slowing down. I think the biggest driver behind that is the interest rates that just shot up, right? Since March, April. it has completely changed the market outlook, what we are seeing. So every month we are revising down our forecast for starts at this point. So near term for the next couple of months, the market is definitely slowing down. Housing market, when we look at permits, starts in July for the first time are below 1 million pace at this point. Existing home sales, pending home sales are both down. New home sales are down at 511,000 at this point for the seasonally adjusted annualized rate. So all indicators are pointing towards a slowdown in the market. That means, you know, the economy is slowing, everything is slowing down. We are not calling a full-blown recession at this point, but definitely slowing down in the housing market. And then the weakness continues for next year too. So I think for me, in summary, it means proceed with caution, right? Be cautiously optimistic, but I think it warrants to say proceed with caution.
I would also just mention, like Danushka said, also some of even the slides that I was presenting from our profile home buyers and sales report last year, where we saw very low weeks on market compared to what we're seeing monthly from our realtors is even, growing more different each month. So we're still seeing that the number of offers going down from what we were seeing earlier this year. And we're currently collecting our data right now for this year's profile of home buyers and sellers. So be interesting to see how that compares to just last year.
I want to pick up on a word that I heard in that answer. It's the R word. Do you guys think, we've been hearing a lot about this in the news. Do you guys think that we are in a housing recession? And if so, why? And maybe expand on what is a housing recession in the first place.
I'm going to say 100% we are in a housing recession. For us, that means that all housing indicators, right, are going down, declining year over year, month over month. So like I said, permits, starts, new home sales, existing home sales, pending home sales, they're all down at this point. So that's why we believe that we are in a housing recession. The minute that the interest rates jumped, everything started showing that we are slowing down. The housing market is definitely cooling off.
Our chief economist, Lawrence Yoon, has also mentioned housing recession in his press releases with the decrease in existing home sales also and pending home sales, but we're still seeing prices continue to increase.
So it sounds like the verdict is in that we are in a housing recession, at least with the new home space. And here in Virginia, we've been seeing those trends as well. The sales declining, and but the prices have not yet turned. So we're gonna keep monitoring those. But thinking a little bit about sort of the pulse of the market, right? The buyers and the sellers that are out there, even the builders that are out in the market. Brandi, I'm curious, you know, with the large portion we saw in the home buyer sellers report, a large portion of buyers and sellers are using agents and brokers, right? And so I'm curious to hear some methodologies, some ways that people are reaching out to these clients now, on both sides of the table. Is there some new trends that have emerged with agents and brokers that are connecting with potential clients based on the survey data?
So actually some new trends and old trends. Looking at some of our older trends that we continue to see. Sure. Some of our older trends that we continue to see is the importance of using, reaching out to your past clients and also referrals from those past clients. So we see that among past clients, that typically makes up about 16% of our members' business. And among our referrals, it's about 20%. And we see that that also increases with experience. So among our members with 16 years or more of experience, we see over 30% for both of those numbers. Then also some of the newer trends that we're seeing is the use of social media among our members to reach out to either their existing clients, to continue those relationships, and also promote their own listings. But it's also a way for them to reach out to new clients and connect with them. And we're also seeing some of the newer social media that our agents are using, including TikTok. So we're still seeing that is emerging. We're seeing increases from just this past year. But yeah, overall, we're seeing that social media is becoming more widely used among our members.
So new ways to engage, new ways to kind of promote your business. It sounds like that's a trend that's, you guys are probably seeing a lot of that. Show of hands. Who here uses social media for their business? Oh, half of you. That's good. So yeah, it sounds like we're going to keep seeing that grow, especially as we think about, who the population of buyers and sellers are, right? As those millennials that we keep talking about, as they, the Gen Zers start moving into the home buying age, I think those tools, those communication tools are going to become more widespread. Thinking about the pulse of the builders now, Danushka, if you could let us know, how have the builders responded to the changing market conditions that we're in right now? We've been talking a lot about that today. And are there specific types of housing that it seems that the demand, has been kind of resilient or more consistent out there?
Yeah, so new home sales at this point, the inventory is at over 10 months. So that means for us, we are expecting that the builders are going to slow down the construction in the coming months. And at the same time, they're having a hard time with the buyer traffic down to all-time lows since 2014. They're doing price cuts, around 5% price cuts at this point. So they are, it's not 2020 or 2021 right now. The market has completely changed on the buyer perspective. When we think of the sub-markets, I think the townhouse market is surprisingly doing really well. I think from the buyer side, it's a great bridge between the, rentership and home ownership, right? It's a lower cost to own as opposed to detached single family. And on the builder side, it's about 2,000 square feet. So it's a smaller cost to produce as well. So the townhouse market, the market share is around 13%. We actually expect it to go up to around 15% in the next couple of years. So, and then of course, the multifamily, the built for rent, the rental market is doing really, really well. It's at at this point, 96% market share is built for rent. Condo share has just been down since the great condo boom years, right? No one wants a condo anymore. So the rental market is doing really well. Townhouse market is doing well too.
That's interesting. Yeah, I've been curious to hear maybe from some local folks later, just how I know that a lot of, zoning codes all around are generally geared towards single family detached. And so it'd be interesting to hear if the townhome model is starting to gain traction in a lot of these markets where there's low supply. So that's something we could definitely follow up on. But
yeah, there are some,
yeah.
I think, cities, I think Portland, Minneapolis, they've essentially banned single family detached at this point. So you can only build single family attached. So there are, and then I think California is now expanding their zoning rules to include auxiliary dwelling units to increase housing supply. So there are some changes that's happening on a zoning perspective.
But I think it's good to know that, the builders, they react to the market demand, right? And so if the builders are building a lot of townhomes, to me, that says that the buyers out there want townhomes, right? And so I think that's an important shift from, it is related to cost, but it's more of a, not an acceptance, but just sort of, this is becoming more normalized, right? Having townhomes, and this could certainly, I think, help when we think about the supply shortages that we're experiencing out in the market. Question for Brandi. Thinking about our industry, who is the typical realtor based on the survey, the member profile report? Did you guys see any significant changes in the characteristics of members between this report in the last report?
So in our member profile that we release yearly, we see that our typical member is 56 years old. We see that our membership is about 66% female. And then they typically have been in the business for 8 years. And we see that the majority of our membership is also sales agents, followed by brokers. And just comparing to the previous year's report, we saw that the number of transactions went up in 2021 to 12 as a median for our members. And then we also saw sales volume also increase. So it'll be interesting to see how that compares this year. And then some of the other demographic characteristics that we've seen continue to change. We see that our membership is becoming more diverse, especially among our younger members and also our newer members. So we saw that this past year, I think it was about 37% of our members with 2 years or less of experience identified as a racial minority. And that was up from 34% last year, the previous year, so in 2020.
So just a PSA, if you guys have any questions, burning questions, feel free to, there's still time if you want to drop them in. But we're going to turn now to some of your questions from the audience and from online and Zoom. Can you speak to how student loan forgiveness will impact the expansion of consumers' ability to purchase a home? And then the second piece of that question is, are there any concerns out there that this legislation is impacting inflation?
From what I've read, like this happened just what, couple of weeks ago, right? The impact on inflation is really minimal at this point. And at the same time, it's $10,000, right? When some of these demographics have hundreds and thousands of dollars. So the impact on increasing the purchasing power is also not very significant from what we've been reading. This is my views, not NHB's views. I want to put this disclaimer out, right? This is a campaign promise, right? That's why it was done. Nothing was addressed to actually do anything about the consumer, the student loan debt. Like you showed the data, I showed the data. You know, the $10,000 is, when you think of the grand scheme of things, very insignificant numbers. So we need to figure out how do we tackle this type of loans, because it's a huge burden for a lot of the households, right? How do we change the structure of these loans, or how do we change the interest rates? Like some are paying 15% for these federal loans, right? Student loans. So we need to figure out, expand this loan forgiveness, or to like, better yet, restructure them is a better way to go about it. But in the impact of inflation or consumer purchasing power, it's very insignificant. So from what we've been reading.
The questions are coming in now. Thank you guys for doing that. This one, I actually had this question myself based on one of the presentations earlier. Could you tell us how it is that 75 to 90-year-olds have student debt, a median debt of $19,000? I'm curious about that myself. Any background on why that's so high?
So we do have some ideas about that. You know, we do get the same reaction whenever we do mention that. But from what we can imagine that these might be parents that are taking out loans for their children. So they're carrying that student loan debt into later ages.
That makes sense. Yeah, last I checked, I don't think my grandparents had that, but I'll have to ask my mom. They may have.
I thought it was continuing education. I was like, yay.
Yeah.
You know?
Yeah. This is a great question. It's a piggyback question off our discussion about townhomes a little earlier. Does this increase in interest from builders to construct townhomes, does it have an impact on timing and regulatory costs? So basically, you know, changing the density from single family to attached, single family detached to attached, you know, does this add kind of time and cost to the builders, and is that going to offset some of the savings of the lower price points of townhomes?
Yeah, so we haven't done the regulatory cost study for single family attached. So I can't really speak to how much the cost would decrease. But on the builder perspective, building for density is of course a better bargain, right? Than building detached single family in these lots. So builders also prefer it too, because there is demand for that because of the consumer side, can only afford a townhouse at this point. And then the fact that these communities are built in more urban areas too. So there's a lot of interest from the younger buyers to be able to be in these walkable cities. So there's a lot of interest there. So builders, if there is a demand, the builders are willing to build these townhouses.
Question now for Brandi. When we think about the different generations, that were in the survey, we have our millennial first-time home buyers, we have our Gen X move-up buyers, we have our baby boomer downsizers. What segment of what generation do you think has been impacted the most by the current conditions that we're in with the housing market?
Personally, I would say younger millennials. I'm in that age group right now. A lot of my friends are too. So yeah, they're just starting to look to purchase their homes. But again, they're entering into the market where interest rates are continuing to increase. Home prices are increasing. So I think just getting into home ownership is going to continue to be a challenge for them.
Yeah, that makes sense. A lot of the first-time home buyers don't have the equity built up that some of the other generations do. Pivoting now to a question from the audience for Danushka, the affordability index that you showed of 43%, hearing that it was the lowest in a long time, what do you see for the future of the single-family home?
Single family demand is there, right? Affordability wise, we need to figure out how to bring these numbers up. How do we make these homes affordable? But the fact that when I showed you on the supply side, right, the labor, the building materials cost, the regulatory costs, I didn't even show you the lending standards. That's being tightened for smaller builders. And it's important because 70% of home building is done by smaller builders, right? And the fact that, all of these together, it's a huge cost for the builders. So yes, single family demand is there. Builders would love to rise up to the challenge. It's just the fact that the issues are long-term issues, right? None of these issues can be solved in their short-term or in easy fixes. So if anybody has suggestions, yes, we welcome them. But it's the chronic issues, right? It's been issues and it's going to be issues. The affordability index, yes, on the buyer side, we need to figure out how do we make these homes more affordable, but then the builder side, how do we build more? That's another way to improve affordability if we have more supply, right? But it's easier said than done to build these houses.
So it sounds that the demand is certainly there for the single family product, but it's really the attainability that is changing. Question now from the audience. This is an interesting one. Are you seeing the heightened political climate impact housing choices, like the location? For example, are people choosing to live in states that are more politically aligned to their beliefs? Are you guys seeing that?
We did this before the election in 2016. We have an index called the Home Building Geography Index. We take the permits from every county and aggregate that according to population. And just before the election, we kind of did like blue states, red states to see what their home building market looks like. It really didn't matter, as opposed to actually versus being a urban versus suburban or the outlying suburbs. That mattered, especially because of the pandemic. We saw the exodus from the urban areas, And now the urban areas are kind of catching up again too. So we saw that as less of any political alliances.
We're getting a lot of good questions, guys. We're not going to have time to finish all of them. But I did want to close our discussion out with sort of an outlook, right? Because we talked about the changes that were happening. We talked about sort of the pulse of the market, both with the buyers, the sellers, the builders. Let's close it out now with where our panelists see the market heading. Let's talk interest rates. We got two questions to close it out. Where do you see interest rates tracking? I know it's on a lot of people's minds. I know your buyers or sellers are all interested in this. Where do you see interest rates tracking for the rest of this year and into 2023?
I think it's going to hover between 5 and 6%.
And then our director of forecasting, Nadia Evangelo, she also puts out weekly interest rate updates, and she is also expecting them to stay around 6%.
Okay. So this is a big one, and I get this question a lot, traveling around Virginia, talking to folks. It's starting to feel a little bit familiar, this pattern that we're in. How is this market not 2008? How are we not doing that all over again? Why is that scenario not a concern? Are you guys seeing that in your data, or how is this different than 2008?
Believe it or not, we get asked this a lot. The builders are getting really nervous because it looks like 2005, 2006, right? But I see two fundamental differences now. The fact that we are a decade of underbuilding, right? Since 2010 to 2020, this decade, we are doing half the building that we were supposed to do. So we have a housing shortage right now. So at NHB, the housing shortage, we estimate it to be 1 million units. Freddie Mac estimates it to be 3.8 million units. I know Lawrence estimated to be over 5 million units, right? So we have a huge housing deficit right now. So that's the first fundamental change. 2005, 2004, 2005, we were overbuilding, oversupply of housing, right? So difference. And on the lending side, it doesn't seem like there's a lot of loose lending going on, right? The lending standards are much higher, much more stricter right now. So we don't really see all these banks just giving out loans to people who can't even qualify for them, right? So that's the two fundamental difference that I see. So yes, it seems like the housing market is slowing down, but I think it's the economic forces that the overall economy is slowing down. That's one of the reasons, that's the main reason that the housing market is slowing down, because in our view, housing market is one of those industries that are very interest rate sensitive, right? And it's also one of the industries that kind of leads the economy out of a weakness too. So big difference, I think, compared to the Great Recession time.
I know that Lawrence also gets asked that a lot. Yeah, I completely agree with what you said. And yes, he also notes about the higher lending standards compared to 2008, and also the high demand that we're seeing.
Yeah, and I think one thing I would add to that too is, when we stack those years side by side now and the housing crash, we talked about the inventory being much different. We talked about the credit standards, but also the job market. The job market today is strong, right? Unemployment's very low. We're adding jobs to the economy. Back in 2008, we were shedding jobs. The unemployment rate was rising. And so when someone is confident in their job situation, they're more likely to buy a home and make a big purchase. And so I think those three are fundamentally illustrate, and hopefully will ease a little bit of anxiety, that we do not see signs that we're heading to another 2008 scenario at this point in time. So if your question did not get asked, please come up after, and we'd be happy to chat with you about it. But thank you guys so much. You've been a great audience and great panelists, and thanks for the discussion.
Brandi, Danushka, and Ryan, we can't thank you enough for being here with us this afternoon. Your insights have prepared us for what's coming, and how to best support our clients. Please note, Brandi and Danushka's presentations will be shared with the membership as well as this recording in Monday's news group e-newsletter. At this time, I would like to bring our economic perspective to a local level. Today, we have Roger Johnson, Economic Director of Albemarle County, here to share some important updates on how the area is thriving. We will have 5 minutes for Q&A after Roger's presentation. If you're in the audience and have a question, please complete an index card and raise your hand for staff to collect. And Zoom participants, you know the drill. Submit your question in the Q&A window of the Zoom toolbar. Roger, I hand the meeting over to you. Thank you.
Thank you very much, Teresa. It's a real privilege to be here. Teresa asked me to speak at this event many months ago, and it occurred to me I wasn't exactly sure how I was going to tie economic development into what the work is that you all do and the profession that you have. And then it occurred to me that we do have something in common. Nobody in this room has any idea what I'm going to talk about, and neither do I. Yeah, I say that in jest, tongue in cheek, but in truth, some of the subject matter that I am going to talk about today is at a local level. So I have invited one of my colleagues, Charles Rapp. Charles, if you'd raise your hand, please. He is the planning director for Albemarle County. And if you have specific questions related or maybe even detailed or any contentious questions for that matter, please direct them to Charles. I'll handle all the others there. Before I get into the presentation, I just wanted to add to something Danushka said. She talked a lot about the rising cost of housing, the reasons for that, and provided the objective data to support those. One thing I will say is the Office of Economic Development in Albemarle County is trying to solve that puzzle from a different perspective. Our goal in economic development is to bring new wealth into our community. It's not necessarily to bring the home prices down, but to bring incomes up to make it more affordable based off of the incomes that they bring in. And we do that through three primary ways. We do that through increasing career ladder jobs and higher paying jobs. And I'll be happy to talk about that in greater detail later. We do it through a tourism initiative where we try to bring overnight visitation into our community. We want them to come here, leave all their money behind and go home. And then thirdly, we do it through direct capital investment. We do that through numerous ways, but generally we want capital from outside the area to come into our area. And we have a strategic plan called Project Enable, which sort of lays out the plan for that. Project Enable differs from some local economic developers' strategic plan, particularly in that one thing that we don't do in our community that many other communities do is go out and actively recruit new businesses. I apologize if you already know this, but this may be news to some of you. Let's say that a company in Germany wants to locate somewhere along the mid-Atlantic. That process works like this. Their site selecting consultant contacts the state of Virginia. The state of Virginia has an economic development department called the Virginia Economic Development Partnership. The VEDP then reaches out across the Commonwealth and tries to find communities that match what that particular company from Germany wants. Perhaps it's a college town, perhaps it's population, perhaps it's income levels, whatever the case may be. And then they reach out to the area that best fits that. And they do that through a regional economic development organization. Here locally, that's called the Central Virginia Piedmont for Economic Development. CVPED is what it's often called. And then CVPED takes that request for information and contacts local economic development professionals like myself and the team that I work with. And we turn around and scan our community to see, one, if it's a good fit for what our citizens want. For example, it's been said loud and clear, we wouldn't want to bring in a business that's not in a good environmental steward. So we would self-select ourselves out of that process. There are many folks who would be concerned about a company that has a high biosafety level, dealing with live viruses. Although we have the experts here in our community to deal with that, the citizens say we'd rather you stay away from those things. So we self-select ourselves out. But when there is a good match, you have local professionals like myself who respond on your behalf to make sure this community does not miss an opportunity to land those types of companies that provide career ladder jobs, higher paying opportunities. Sort of, if you could imagine two people eating candy rope at one end, you may be trying to lower the home prices, but we're trying to increase the income. So I just wanted to add that context to what Danushka said earlier before I got into my actual presentation, if you would, please. Is my presentation in here? Yeah, there's Charles. Okay, so I sort of mentioned these things, but when I say outside of our area, I'm particularly talking about Greene, Fluvanna, Charlottesville, and Albemarle. That's something we call a metropolitan statistical area. So if a company provides a good or service here locally and sells it outside of that area, all that wealth comes back into our community to help our coffee shops thrive, to keep our community unique in the way it is, as well as providing additional income to buy houses. So that's sort of what we focus on: higher salary and wages and the like. So let's get into some specific projects. And Teresa suggested that I talk about what's happening at the local economy in terms of projects. So I won't provide the granular details and or objective analysis that you've heard earlier. Some of this will be anecdotal, but suffice it to say, all the things that Danushka reported to you earlier at the macro level is exactly what's happened here at the micro level. We're facing the same things: workforce shortages, increased costs, increased regulations, and the like. Where we may differ from other communities is that our tourism sector is booming, meaning that people are coming here in droves. The cost of hotel rooms are driving up, and they're leaving a lot of money behind. We track that data on a regular, recurring basis, and suffice it to say, it's definitely increasing. What you see here is a picture of Barnes Lumber. To orient yourself, this blue star is to indicate where this particular project is taking place. It is, I'm gonna grab this microphone. Can you hear me okay? Is it working? Okay, so Barnes Lumber is located here where this star is. It's a public-private partnership. A little bit about this particular project, if I can get this thing to work, is this is what it looks like today. And this is sort of the downtown area, if you're familiar with Crozet. This is what it will look like after it's built. That's sort of a massing diagram. The yellow sort of indicates the maximum size that can be built according to the agreement that we have. Obviously, all those buildings won't be 3 stories. You'll also notice that in sort of the top left-hand corner, there is a public plaza. That is a portion of the project that is required and is part of the public-private partnership, and then a new road network. So in order to get that built, the community said, yeah, we're okay with you building a new downtown in Crozet, but what we don't want you to do is to build, sort of a modern building, a code building, if you will, if you're familiar with that. It's been built downtown. We want to keep this same small town architecture. They also said we'd want to have a public plaza so that the community can get together for fireworks or parades or have a place to work and play at the same time. And then ultimately the developer said, wait a minute, you want me to build the roads, you want me to build a public plaza, you want me to build construction that's more expensive, because building individual buildings is much more expensive than building larger buildings and so forth. The developer agreed, we'll just do vertical articulation. We're going to build big buildings, but it'll look like this. But all of those things increase cost. If you want me to do this, community, you're going to have to help. So the county entered into a public-private partnership whereby the developer will build the things that we just mentioned, and then we will rebate his taxes until we pay off the cost of that park and the cost of some of those roads. And that allows a building to take place that the community wants that wouldn't otherwise happen. That's one way in which we bring new capital into our community. Some other projects of interest are around the community is the Sieg property. Let me orient you just a little bit. The star is to indicate where this is taking place. This is 64 and 29. A developer has possession of that property, and they are proposing a mixed-use development. It's going to have a mix of residential, 500 minimum units with a maximum of 1,365 units. It's going to be a mix of single family, detached, attached, and multifamily. It will also have some non-residential components associated with it, somewhere between 100,000 and 1,000 square feet of commercial space, which will include things like retail, restaurant, breweries, library, hotel, et cetera. So that's going to be a mixed use development right there on 6429. Another project that may be of interest to this group to make sure you know what's going on in your community is at the North Fork Research Discovery Park. They too are going through a rezoning process. Just for those that may not be familiar, Charlottesville, Albemarle Airport, 29 North, the star indicates the area that we're talking about. They're going through a rezoning application. They're asking for 3.7 million square feet of industrial. It's important that we still have space for job producing activity in our community. So the research park is not necessarily giving up all that particular space. However, they do want it to be mixed use, if you will, and that will include a minimum of 200 residential units with a maximum of 1,400 units, and some non-residential square footage is to be determined, but no less than 10,000 square feet. There's also some talk about having other commercial components, sort of a main street, if you will. And the goal of the UVA Foundation, which is the owner of this particular parcel, is to make it a place that both people and businesses want to locate. I will also mention that you probably heard about UVA announcing they're going to produce a large number of affordable units to be good neighbors and sort of meet their goals to have community ties. A healthy portion of these particular residential units are expected to be affordable in order to meet the sort of the goal that they've set out for themselves. Lot of interest always in the Fashion Square Mall. Everybody wants to know what the heck's going on with that. I'm going to pretend like you don't know where it is, but this is it. There's 29. There's Albemarle Square, if you will. So a lot of people aren't aware of the complexity associated with this particular site. It actually has 3 different owners with it. Richard Hewitt, he bought the JCPenney portion of the site, and JCPenney is located right here. And then the middle portion of the site, which includes this area in particular, not this building, but this area went into receivership. They couldn't pay their bills. That receivership was owned by a bank. And then this portion of the mall was owned by Sears, which includes these out parcels as well. Well, just late last year, a developer has bought this portion of the mall, but for Belk over here. Belk is owned by its headquarters in Charlotte. So people want to know why that didn't redevelop the way we had hoped, or is having difficulty redeveloping. There's a lot of complexities to making that happen. Trying to get 3 people to agree on anything is not easy, much less 3 millionaires and or their owners. But what the county is doing for that, we thought may be of interest to this group. They adopted something called form-based code. And it's a different way of looking at what's allowed in a community. It's not what uses go in that particular location. It's what the buildings look like and how they orient to the community. So one thing a developer could do is opt into form-based code, and then the uses that go in here into the mall area itself could be up to the developer, provided there's nothing of major consequences like noise or pollution or something of that nature. They'd have to ask for permission to do that. But generally speaking, it gives a developer the opportunity to build out the way they want, sort of by right, if you will. It's not required that the development community opt into that. It is option and an overlay. Many developers may choose to do things by right because of the pre-development costs that are associated with certain things. So we're not sure if that's going to work out exactly as planned, but it certainly is a new tool in the toolbox for the county to try to get the mall to redevelop in a way that this community so desires. And then lastly, this is a housing development. I'm certain you may be aware of this one as well. This is John Warner Parkway, Dunlore Drive. That's K-Tech if you know where that's located. I will say that down here is the county office building. So we're talking about this star in particular. It is a residential site plan has been submitted called Rio Point, 284 multifamily units, 11 attached townhomes, and it's all expected to be rentals. So with that being said, I'm going to invite Charles to come on up here in case there's any questions about any of these projects. Somebody will be equipped to answer those. But what I had hoped to do was provide an overview of projects that are in the pipeline. So as you go out and about and your clients ask what's going on at this particular location, or you can tell me what my neighbors are going to be doing, you'll be well informed. We're happy to take any questions that you may have that's associated with any of these projects or any that we didn't talk about.
Didn't Albemarle County rent part of the mall?
The question was, original question was, didn't Albemarle County rent a portion of the mall? And the answer to that question is yes, they have leased space in the J.C. Penney portion of the mall, which is owned by Richard Hewitt. And the purpose of that is to handle the overflow of equipment and other storage requirements that are necessary for both police and fire. Currently today, they don't have those things stowed, and there's other hazmat materials they need to have access to and storing evidence and the like. So those types of things will take place there, along with expected a couple of other employees to be stationed there as well.
My second question is, with all of the new development north of Walmart, Sam's Club and Walmart right there, and then the project that you were just talking about near the airport, is there another school coming to that area?
Are you talking about North Point development? It's up on 29. Yeah, so that's, I guess, are they all detached, Charles? I'll let you address that question.
North Point is the one that's across from the UVA Discovery Park, and that will have single family residential. It has apartments. It has a whole variety of stuff. There's a big commercial area component too that'll be phased in. There's also Brook Hill, which is probably what you're talking about, across from kind of the Holly Mead Town Center when you just get past the river there. Both of those developments is what we call a proffer. They proffered a school site. So there's an elementary school site in both of those. In the current capital improvements plan for the county, they've funded one of those school sites. And then funding for design of another one. So it's kind of a phased approach as they need it. I believe the school board is currently looking to see which site they want first, and it kind of depends on how the housing develops in both of those developments. But there certainly is school opportunities in those, and we have land for that. There's also another site that's across the street in the wooded area, across the street from Forest Lakes, that was also proffered from Brook Hill for potential school use as well. So.
The project in Crozet, when is that projected to begin?
Well, the project itself has begun. What is a significant milestone that just happened this past month is that road plans have been submitted to VDOT, 60% complete. If you're not familiar with the construction process, that is a major milestone because getting to that particular point requires agreement between infrastructure, VDOT, the Albemarle County Service Authority, and other folks, as well as having the identified funding set aside at the county level to carry out the whole project. With that being said, once you get to 60% road plans, you can begin doing other types of planning, the grading work and the stormwater work. So while you may not see vertical building going up soon as VDOT formally accepts those 60% plans, which we believe they will, you will start seeing grading and moving of dirt. The developer expects it to be somewhere in the neighborhood of 13 to 18 months before a portion of that particular phasing starts being built. And if I can go back, I will try to. I'm not sure I'm going to be able to operate this thing.
And so that's businesses, parks,
Well,
as well as residential?
Yeah, it's going to be built around the park. If you may remember where that public plaza is, it's going to construct there first and then work its way toward where Perrone Robotics is or where the old Barnes Lumber site is, if you're familiar.
Kind
with
of
it.
like right up against the bicycle shop, right?
Yeah, the bicycle shop would be part of the public plaza today. So we're working with those businesses to minimize the disruption.
I'm excited. I live in Crozet.
I may have a geography off, but I think the Kmart site is actually in the county, isn't it?
No, sir, it is not. It's
Is
in the city. Yes, sir.
But it impacts a lot around the county. Is there any word of what's happening with that since it's sort of stopped in its tracks with the Target problem of traffic flow and such?
anything that I shared with this group would be secondhand information, and I can't 100% say it with veracity. So if you'll just please allow me, I'm just going to pass on talking about city
Okay.
plans associated with that.
With the new developments you've been speaking about, your housing ranges, 200 units to 1,400 units. Who or how and why do those get determined? That's
well,
quite
I'll
a wide
speak to-
range.
I'll start and then I'm going to kick it over to Charles because he's the expert here. But UVA Foundation, which owns the property up in North Fourth Discovery Park, plans to, if the rezoning goes through, they don't plan to build the housing themselves. They plan to put out a request for a developer and they'll open it up, and each one of those developers will submit a plan of how they would build that out to include the number of units, the number of affordable units, the commercial layout and the like. So a large portion of how that particular development will be built will also be determined by market conditions, as much by, the large scale. I think if I'll kick it over to you, Charles, you can speak to the minimums and the maximums better than I.
Yeah, and part of that is inherent to our zoning regulations here and our future land use designations. We have a very wide range. We have a lot of the major corridors are urban density residential, and that ranges from 6 units an acre all the way up to 34, which I understand why maybe that was done in the past. It provides a lot of flexibility, but it really provides no clarity as to what density level you're going to get. And so it's quite open, and that's why you see such huge ranges. Developers don't want to necessarily give up that high end because the market might suddenly want it. And they want the option to go way down. They don't want to be limited. But it obviously creates some challenges as to people understanding what's coming next to them and what could be built in future, as many of these developments like Brook Hill and North Point can take 20 years to even kind of materialize and really start to take shape.
All right. Thank you very much for your time and attention.
Thank you, Roger. Roger's presentation will also be shared with the membership, as well as this recording in Monday's news group e-newsletter. At this time, I'd like to invite Pat Jensen Leadership Academy Co-Facilitator Rachel Burns to the stage to announce the 2022 through 2023 participants.
Thank you, Pam. So I am here to introduce our Pat Jensen Leadership Academy. Anthony has left for Blacksburg for the first football game, so I'm flying solo. So the Pat Jensen Leadership Academy was founded in 2017, and it is intended to foster knowledge and encourage further movement of volunteers into additional leadership roles within Realtor organizations at the state, local, and national levels. For those of you that didn't know Pat Jensen, she was a tremendous Realtor, broker, association president at both local and state levels, as well as a leader and an advocate for RPAC. Anthony and I will be serving as co-chairs of the Pat Jensen Leadership Academy for 2022 to 2023. And I'm thrilled to announce our participants. Will you please stand if you are here today? We have Roxanne Carter Johnson. We have Woody Fincham. Aaron Howell. Brittany Kozik. Caitlin Mancini, who's already standing. Janice O'Hare. Kyle Olson. Amanda Spagoni. Candace Vanderlyn. And Josh White, who snuck out the back. Let's have a round of applause for all of our participants. These individuals will participate in eight in-depth sessions with subject matter experts from around the Commonwealth and gain extensive knowledge to set them up for success in their leadership journeys. We wish them the best of luck and look forward to watching them bond as a group and, most importantly, flourish into leaders for the Realtor Association and our community at large. Thanks, guys.
Thank you, Rachel. As a part of the inaugural Pat Jensen Leadership Academy class, I can attest to how valuable the program has been to my development as a leader of the association, but also for my personal growth as a business professional. If anybody has the chance to be a part of this program, I strongly recommend it. While I'm on the topic of professionalism, it is the perfect time to move into the next segment of today's program. The Virginia Realtors Honor Society rewards and encourages participation in leadership and educational activities at the local, state, and national realtor organizations. Oops. On behalf of the entire membership, I'm thrilled to recognize the following realtors who have been invited into the 2021 Virginia Realtors Honor Society. If these individuals are present today, please stand as we recognize you. Kim Armstrong, who's also receiving a 20-year pin. Reeves Bailey. Myself, Pam Dent. Tele Jenifer. Kathy Markwood. Donna Patton, also receiving a 15-year pin. Denise Ramey. Pat Surrey. Pat Wilhelm. And Arlene Yobs. We congratulate each of you on your amazing achievement. Honorees, if you're present, please stay after the program to accept your accolade and take a group photo on stage. The Board of Officers and Directors are essential to CAAR's future and provide unique perspectives when voting on important association motions and initiatives. I would like to welcome Tele Jenifer and Donna Patton, co-chairs of the Candidate Review Committee, to share how you can apply for the CAAR 2023 Board of Directors.
See if I pull it down. Can you hear me? I don't have to pull it down? All right. They gave me a script. I have to stick to it because Donna's talking part of it and I'm talking part of it and I don't want to overlap mine. So anyway, thank you, Pam. Following a CAAR bylaws update in December of 2021, the Board of Officers and Directors nomination and election process changed to be more inclusive and engaging. An actual election process was developed where the member can get to know each candidate running for office and vote for the next slate of officers and directors. Candidates interested in running for office can learn more about the process and applying using the Board of Directors candidate application icon. And I had to go look at it today. And I finally figured it out that it is a person at a podium, but it almost looked like a person in a bathtub. So that little blue. So I needed to watch it.
Do you have people
watching you in your bathtub? Well, I thought it was the feet. I had to look really close. New glasses are coming. But anyway, it's going to be a great process. We just need to have a lot of applicants. You must complete the entire application in one session. Therefore, we recommend you download the PDF version and prepare your answers in advance.
I didn't get the funny part. When a candidate application is received, the candidate review committee will confirm the eligibility of each candidate as noted in the CAAR bylaws. This candidate review committee includes the following members listed on the screen. We're accepting nominations for 6 vacancies for the role of president-elect, treasurer, 3-year director, and 1-year director. A board candidate webpage will be developed, which it already has, hasn't it?
Yes.
Candidate website, sorry, to show all the candidates running for which positions. The web page will include a picture and contact information of the candidate, as well as an optional video message. You might want to rehearse that one before you record it. The official ballot will be announced to the membership 2 separate times.
Yes, because those videos that you have to give, I had to give one for one of the past presidents, Tom Wolfeck, and I only recorded it probably 10, 15 times and said to my husband, is this okay to send? So videos, but do it because it is really nice. The voting window will be open for 24 hours and the results will be announced in real time during the November general membership meeting and annual business meeting on Thursday, November 3rd from 9 to 10:30. So put that on your calendars and make sure you all go online and vote. The GMM will be here at the Hinsdale Conference Center. If you wish to learn more about the new election process, please download the infographic. And I did that before I left and left it on the copier. We encourage you to step up and apply for a CAAR 2023 officer or director position today. I am so glad I did that. And it has been really wonderful. So
Yeah, I have to echo that. If you have not gotten involved, going off strip, staff's nervous.
I know. We gotta hurry.
I know. Do it. You will be glad you got involved. You will be very glad that you are part of shaping our association.
Yes. Thank you, Tele and Donna. Before we start to close today's meeting, I would like to congratulate Patrina Tyree on receiving her Virginia Property Management Certificate. What a great achievement. To conclude this morning's meeting, I would like to welcome the following new Realtor members. They're on the screen. In addition, I would like to welcome the following new affiliate members. Thank you again for joining this morning's meeting. As always, please check the CAAR Education and Events calendar for upcoming education, events, and programs. As a reminder, we have the following general membership meetings left this year: a November general membership meeting, an annual business meeting on Thursday, November 3rd from 9 to 10:30 a.m. at the Hillsdale Conference Center, and the December GMM and installation, which has been broken into 2 separate events this year. The December GMM will be from 9 to 10:30 on Thursday, December 8th at the Hillsdale Conference Center.
will include an influential first panel discussion with various individuals who have made monumental steps in the local real estate industry. The installation of CAAR 2023 officers and directors will be from 5:30 to 8:30 p.m. on Thursday, December 8th at the Hillsdale Conference Center. It will include a reception to celebrate a milestone in CAAR's history, as S. Lisa Herndon will be the first African-American president at CAAR. What a milestone. Registration is open for all the events just mentioned. We hope you can join us. I hope you have a great rest of the week, and the meeting is now adjourned.